Okay, thanks for sticking with us as we're continuing today's lecture. We're going to talk about cash, fraud, and internal controls. Define a lot of things for you. We'll talk about internal controls, why they're important. We'll talk about fraud and why it happens. And we'll talk about cash, of course. Cash is king, as they say. And so we'll spend a lot of time talking about the cash parts, because I think those will be the most important. First, let's talk about internal controls. An internal control system is a set of systems that work together in order to protect assets, ensure reliable accounting, uphold company policies, and promote efficient operations. That is what internal controls helps to govern. Okay. The best way to think about internal controls is they're designed to protect the company. All right. For example, we protect assets in a retail business. First thing that comes to my mind is security cameras. We got security cameras. We got the detectors at the doors that chime when somebody forgot to remove the security tag, or somebody might be, walking it out the door. Those systems are designed to protect the assets. Security cameras, the gates at the doors, safes. I mean, yeah, believe it or not, like the ones with the keys, or the ones with the turning thing on it, on the front, the combination safes. That helps to protect the cash. Cash is an asset, remember? These are all part of internal controls. The safe, the cash, the cash register itself is a system of internal controls. It helps ensure reliable accounting. The security guards, the security cameras, the security tags, all of these things help to protect assets. For reliable accounting, we have the cash registers, of course. We have a cash room where individuals count the cash. Cash machines count the cash. There's a lot of different ways that we ensure reliable accounting. Okay, those are just a few that come off the top of my mind. Uphold company policies. For example, some companies have return policies. Oh, the customer can't return it without a receipt. Like, why do you think that is? Because how do they know where it came from? It's like, oh, I bought a pair of jeans over at TJ Maxx. Would I return it to Walmart? How do they know? I mean, there might be a tag on it, but if I remove the tag, I don't have a receipt. They don't know. They don't know where it came from. Okay? So that's why company policies dictate you have to have a receipt if you want to get a refund or exchange. You have to have the tags on. Upholding company policies, And then promote efficient operations. I think that's relatively self-explanatory, but when it comes to promoting efficient operations, I think of like internal controls being able to provide guidelines for employees on how they act. For those of you who work in HR, for example, the handbook, the employee handbook, it's designed to promote efficient operations, isn't it? I think it is. And uphold company policies. The handbook itself, that's a system of internal controls. That's why companies have them. Just a couple of examples of internal controls. So fraud is huge in accounting. I'm sure you know that by now. You've seen it. Some of you have lived through it. Remember Bernie Madoff? Some of you are too young to remember Bernie Madoff, but Bernie Madoff was a huge thing. So what happened was this investment banker type guy on Wall Street was kind of cooking the books a little bit. But how was he doing that? Oh, he was recommending certain uh, customers buy certain stocks and making it look real good. Kind of making it look like companies had better sales than they did. And of course, customers would invest with this guy, and then what did he do with the money? He went off and had some fun with it. And then sometimes the investor would come back like, "Hey, I want to get my return. I want to get my payout." Well, Bernie went and spent the money, so then he had to find the money from somewhere else. Other investors pay those investors back. Other investors pay those investors back until the system collapsed. So, just one of many examples. Yeah, exactly. Ponzi scheme. Right. Oh, yeah. The Silicon Valley Bank. That was the latest one, right? We had FTX. That was another good one. Yeah, Liz. Liz, you're thinking of all the good stuff. Oh man, I haven't thought of those ones in a while. Yeah, FTX. Yeah, there were so many ridiculous situations that happened. Oh, for those of you who might remember Enron, Enron was another big one. So Enron, what they did is
Is that 1980s?
that was 1990s. So
90s, okay.
yep. So I mean, the company's was around for a long time, but yeah, in the early 90s, what happened was, and this is when it started, it didn't end until 2001, I think. What happened was is that Enron, which was an energy company down in Texas, what they were doing is, and they were publicly traded. What they did was they made their sales look really freaking good, and they weren't. They were making up like fake sales in their accounting system, and they were passing it off as being legitimate because what they did was they created shell companies to be the customers of Enron. So it was like this very convoluted shell game that they created, and so ultimately what happened was is that besides the fact that eventually people started figuring out what was going on because the stock market, their stock price was going up and up, and it's like, oh, everything's looking great. They've got all these sales, and then all of a sudden it's just like, oh, so somebody on the inside was like, wait a second, this don't look right. So they called up, the whistleblower, right? The whistleblower was like, hey, something ain't look right here. We need somebody to look into this. And so government comes in, they start auditing. Hey, those sales ain't really there. So yeah, that's fraud. So the stock market for that company collapsed. Their stock price collapsed. A lot of people lost a ton of money, and a couple of people went to jail for it. The CEO, CFO, all those people went to jail, and and that's how this slide here, the Sarbanes-Oxley Act, was created. So the Sarbanes-Oxley Act was created in 2002, and the way it was designed for is that it requires all publicly traded companies to be audited by external public accounting companies. Okay, and so we call them the Big Four. There's KPMG, there's PricewaterhouseCoopers, there's the two other ones I can never remember, but they're there, right? And so these Big Four companies, what they do is they provide service to publicly traded companies to audit their books, and they do that once a year. And so that's what the Sarbanes-Oxley Act requires. It also required companies to have a strict system of internal controls, and all these kinds of things. And so all that to say is that Sarbanes-Oxley Act of 2002 was designed to protect shareholders from being defrauded by publicly traded companies. In a very general sense. I could talk for days on that stuff, so got to be careful on that subject with me. Yeah. Committee of Sponsoring Organizations, also known as COSO, is designed. It's kind of like a nonprofit agency, yeah. But what they did is they created a system where companies who are publicly traded utilize their framework to help to govern their business in a ethical way. And so what COSO does is it provides a control environment, risk assessment, control activities, information and communication and monitoring, provides the guidelines for these things for the company structure. So for control environment, that's company structure, ethics, and integrity for internal control systems. Risk assessment includes identifying, analyzing, and managing risk factors, both internal risk and external risk. Internal risk would include things like employee potential theft or potential wrongdoing. External factors of risk would include things like competitors, regulatory environment, etc. Anything external to the company. So risk assessment. Control activities are policies and procedures to reduce the risk of loss. Okay, this would include things like implementing security cameras or implementing a system of internal controls. Information and communication is where we report to internal and external parties of the company. Information and communication means we're being transparent and providing reports to internal and external stakeholders. And monitoring is the regular review on the adequacy of the internal control processes, meaning, yes, we're adhering to our policies and procedures. So that's what COSO is. Help to establish a system of internal controls. So these are the principles of what internal controls are and what they do. So one is establish responsibilities. An example of this is separating responsibilities, or how do I want to describe this? A lot of companies, what they do is they separate responsibilities. Here's an example of that. One person counts the cash, and a separate person takes it to the bank. It's a separation of duties. One person counts the cash register drawer. A second person validates it. Separation of duties. Yeah. You keep going, but that's what established responsibilities means. Who does what? Maintain adequate records. No kidding. I mean, you want to make sure that your information is correct and that you have enough information to provide. Number 3, ensure your assets and bond key employees. Okay, here's what this means. Ensure assets. Insurance. Have insurance on your building, plant, equipment, and employees. Insurance. Bond key employees. A lot of people don't know what this means. When an employee is bonded, it means that they have a legal duty to the business, a legally binding contract with the business to be responsible for protecting the assets. That's what it means to be bonded. When you're bonded, you've signed a legally binding contract with the business. This is common for key holders. Okay, if you have a physical key in your pocket, and it's because you have the key to the door of the business, you're a bonded employee. Number 4, separate record keeping from the custody of assets. The person counting the cash should never, ever, ever be the same person taking the cash to the bank. For the obvious reason. Put cash in the pocket. Number 6, apply technological controls, security cameras, computers. I can't believe I have to say that. Other things, tracking devices, I don't know. There's a lot of things, right? Technological control. And number 7, perform regular independent reviews. Okay. This is where your one of the big 4 accounting firms comes in and does the audit. Independent review. When it comes to establishing responsibilities, the task should be very clear, assigned to one person, and that helps to determine who's going to be at fault when something goes wrong. If you're at fault when something goes wrong, that means you were responsible. That's what it means. Maintain adequate records. Protect the assets. This helps management to monitor the company. It includes things like detailed records using the chart of accounts, pre-printed forms, pre-numbered sales slips, computerized point of sale systems. It's kind of like when you go to the restaurant, right? They got the little ticket. It's got a little number on it. It's a pre-numbered sales slip. Yeah. Oh, the bonded keys. Yeah. That's what I was talking about earlier. Assets should be insured from an insurance company, preferably. Employees handling the cash and other assets should be bonded. Okay. Bond means the company has purchased an insurance policy against theft by that employee. They've also signed a legally binding contract. Divide responsibility for related transactions. Please make sure you have somebody else counting the cash is not the same person taking it to the bank. I can't say that enough. I've seen a lot of things in my day, so that's why I said it. Employees would need to include agreed in secret in order to commit fraud with this type of control in place. So if the two employees are working together, that's another thing. It's not a problem. But the idea is you always got somebody watching someone else. Yeah, checks and balances. Gotta have checks and balances. Divide responsibility between 2 separate individuals. Of course, one person accesses checks and balances, prevent fraud. We call this a separation of duties. Technology, cash registers. I know, amazing, right? Time clocks, scanners, security systems. These days we have this thumbprint thing, fingerprint readers. We have retinal scanners, fingerprint readers, dual factor authentication. Yeah, these are all systems for internal control. Independent reviews. Yeah, so one of the big 4s comes in and audits. They make sure the books are accurate. Technology, fraud, and internal control helps to reduce process errors, provide separation of duties, provides new evidence for processing. It's more extensive. It increases e-commerce. Oh, and it provides trust. That to be on here. I'm surprised it's not. Trust is a big part, right? It's like I trust companies that are responsible with my data. Yeah. This part's relatively a little newer, I guess. Blockchain. So I'm sure some of you have probably heard of what blockchain is. It's a more secure type of accounting ledger. Blockchain is a continuously and simultaneously updated and verified. The technology makes it difficult for the ledger to be modified without a detailed record of change. The records cannot be destroyed or hidden because the record is shared and stored by multiple users. That's what blockchain is. It's a string of data put together, what we call a chain. A block of that data on a chain is called a blockchain. It's a relatively newer concept, but it's very encoded. It's very specific. It helps to ensure the protection of financial data and information. Thank you, Liz. By the way, I forgot to say thank you. Deloitte and Ernst Young were the other two big four that I couldn't remember. Thank you. Limitations of internal control. Humans are still humans. They still make mistakes. Yeah. So sorry, that's kind of how it works. Humans are sometimes intentional in the things that they do in a bad way. They might commit fraud. We use a fraud triangle, which includes opportunity, pressure, and retaliation, to understand why individuals commit fraud. And one of the last constraints is, of course, the cost benefit. Sometimes the costs of implementing internal controls outweigh the benefit. We don't want that to happen. You want benefit to outweigh the cost of implementing the internal controls. How do you get a good system of internal controls? So that is our talk on internal controls. We talked a little bit about the cash part, but now we're going to dive a little bit deeper into cash to understand what cash is, what cash equivalents are, and how we report cash. All the fun stuff. I love cash. Cash is king. I think I said that before. I'll say it again. Cash is king. Cash is the control of cash is an effective system of internal controls that we talked about earlier. It helps to protect the cash and cash equivalents. It helps them to meet these very specific guidelines. Handling cash is separate from record keeping of cash. The person recording the cash sales should never be the same person handling the cash. Obviously, could be a problem. Cash receipts are permanently deposited into the bank. We don't wait till the next morning to drive to the bank when we close the store. We close that store, we're driving to the bank before we go home. Drop that deposit into the bank. Cash payments are made by checks or electronic funds transfer. I don't know if you know what a check is. Some of you might be too young to know what a check is.
Stop it, Professor.
Hey, I think I'm being serious these days, because I tell you what, I met a young person the other day, and they asked me what a check was. And I looked at them and I was like, you serious? Yeah. And I'm like, yeah, what's a check? I said, well, it's just paper. It's a piece of paper and it's got some numbers on it. And it has a dollar amount and it tells you who it's from. What you do is take a picture of it and you deposit in your bank account using your app. You know, they probably don't know what a bank is either. It's a physical building that you walk into. Some of them even have safes. Okay, but these days, you know how it is. What I actually, you know, honestly, I haven't been to a bank in a long time. It's probably been a couple of years. Why is that? The app does everything.
Yeah.
You know, I take a picture of the check, front and back. And as soon as I click submit, it's in my account. Okay.
Yep.
So the bank app is your bank. And oftentimes there's someone there. So like if I call them, they pick up the phone. Amazing. You know, so going down to the bank, I just don't do it much anymore. It's very rare. I'm making a physical cash deposit. That's different. I can't take pictures of cash. They won't take that. So electronic funds transfer, I'm sure you know this, but it's when we send money from our bank to another, or from our bank to pay for a bill. You pay for a bill using your bank account. It's called electronic funds transfer. Electronically transferring funds. What is cash? Oh my goodness. Hopefully I don't have to explain this part too detailed. But cash is currency, coins, deposits into your bank account. That's cash. Okay. It's that little paper. It's green sometimes. So it's like a green color. They got numbers on them. 1, 5, 10, 20, 50, 100. Yeah. Sometimes if you're fancy, you got one of them 100 ones. But that's called currency. It's paper money, right? But it's king, and it can buy you anything. Promise. So you got coins, bank deposits. Check is the same as cash. It really is. It works the same darn way as cash does. The only difference is you have to deposit into your bank in order to use it. Yeah, you can't use a customer's check to go to the grocery store and use a customer's check to pay for your groceries. It ain't gonna work too well. But you know, customer checks, cashier's checks, certified checks, money orders, all of these things are the same as cash. You just deposit them into your bank account. Cash equivalents, on the other hand, is similar to cash. It can be converted into cash. For example, short-term investments, stocks. You bought a couple of single stocks on the market, no problem. Sell them, liquidate them, convert it to cash quickly. That's what we call a short-term investment. Highly liquid investments that can be converted back into cash. They're close to maturity date and not sensitive to changes. Bonds, short-term bonds, a 30-day bond, 60-day bond, 90-day bond. These are what we call short-term bonds. They're kind of like loans in a way. They work the same way. They have an interest rate associated with them, an annuity payment, maturity payment, etc. Bonds, stocks, these are what we call short-term investments. You quickly convert back into cash. It's important to manage your cash. You have to manage your cash appropriately. Why? Because if you run out of cash, you run out of business. Okay? Don't run out of cash when you're in business. You will close your doors the next day. Promise you that. Okay? I'm just saying. Okay? You got to be real careful when you manage your cash, especially in business. Now, oftentimes there's laws governing the amount of cash reserves you should have in your account at all times. Personally, we call these emergency funds, but in business, we call these reserves. Okay, the way it works is if you have employees, you have a separate bank account, separate savings account for payroll. And you don't mess with that account. The payroll bank account is only for payroll. You can deposit cash into that account, but don't you dare try to take it any out. Okay, separate bank account for payroll, please. This is a requirement in most states, most places. You have your payroll account, that's used to pay payroll. Okay, nothing else. Then you have your operating account. This is to pay your day-to-day expenses, your utilities, your vendors, your whatever else is. Okay, your everything else. But you need to make sure that you always have enough cash on hand to do these things. Because if you run out, you will be out of business. Very simple. So just make sure that you always have enough cash on hand. We apply internal control processes to cash because we need to control the physical flow of cash, and we need to make sure that our accounting records match the cash we've received from our customers and the cash we've used to pay our bills. This is a nice, cute little graph that shows us a flow chart, we'll say. It's a flow chart that shows us the flow of cash, basically. Okay. We have a nice sales lady working in a retail store who is closing up for the night in the top left corner. She's closing out the cash drawer, validating that the amount of cash she received from the customers matches the tape from the register. Okay, that's the amount of cash we received. Here it is. Count it out. Yes, that matches. Okay, great. I take that, I put it into my bank bag along with a cash sheet that tells me who I am, how much money's in there, and what day it is. Put that in the bag with the cash, close it up, and you either bring that to the back office and put that in the safe, or you're handing it to the manager, who then validates the cash is there, how much cash is there. Then they send the report to the accounting office, and they bring the cash to the bank. Okay. Accounting office validates and enters it into the accounting information system. That's the process. Most retailers follow that process. I say most because not all retailers are the same. Sometimes I've done this before. Okay, I worked in retail. I think I told you the story, when I was in retail at the age of 15 and 16 and 17 and 18, a couple more years, when I started out in retail, sometimes you forget to give customers change. Once in a while I'll see a young kid, working at a retail establishment. And they'll give me the wrong change. It's like, I get it. It happens. Okay. I've done it before. You get in trouble doing that. You gotta be careful. Okay. So here's how it works. Let's say you forgot to give customer $5. Okay. I don't know what customer would overlook that. I know I wouldn't, but some customers do, right? So you forgot to give $5 worth of change to your customers. Whoops. You still have to account for that $5. You can't just, slip it in your pocket. Don't work that way. You have to account for it. So you debit your total cash, even the overage amount. So sales plus a difference. That's your total cash. You look in the cash register, you count it out, and there's $555 in there. The register said that you only made $550 worth of sales. That $5 came from somewhere. You forgot to give the change back. We call that cash over. The technical account name is called cash over in short. So we have to make an adjusting entry. Debit cash, $555. Credit sales, $550. And then we credit the difference to cash over in short, $5. That's when your cash drawer is over. You're over by $5. When it's over, we credit the account. But what about when I didn't collect enough from the customers? Whoops.
Someone stealing.
This will get you even more trouble, I promise you. The other one, they might be a little upset because, you forgot to give change to your customers. This one, they'll be real upset because you didn't collect enough. Or like Leland said, it wound up in the pocket. So here's what happens. You still have to account for any shortages. It's like, well, whoops, yeah, I gave a customer back too much change. I've done that before too. You get in trouble doing that. Right? So, debit cash, the amount that's in the drawer, in this case, $621. Our sales were $625. So credit sales, $625. Clearly, there's a difference here, $4. I debit when there's a shortage. Debit cash over in short, $4. Make sense? It makes sense, right? It shows you what happens when there's a difference. And this happens. I've seen it. I've done it. It happens. It's part of life, especially in retail life. Okay. Receipts by mail. This one always makes me laugh. Never put cash in the mail. Don't do that. I've seen customers do that. Don't do that. Don't put physical cash in the mail. What's wrong with you? The mailman knows what's in there. Okay? They won't make it to the bank. I promise. They won't make it to pay your bill. Don't put cash in the mail. Put a check in instead. Don't put cash in the mail. I don't know how many times I have to say that to everyone. I see people do it. I'm just like, what are you doing? Here's how cash receipts work. Sometimes customers pay their bill through the mail. Okay, no problem. They put a check in, and they usually, hopefully, include the remittance. The remittance is that little, I don't have any bills laying around. At the bottom of the bill that you received in the mail, there's that little part on the bottom. It says payable to, and it has the amount that you owe and where you need to send it. Okay, you tear that little bottom piece off. You put it in the envelope with your check. That little part you just put in the envelope, we call that a remittance. Remittance. What it does is it tracks your payment to your account. That's why it's important. So usually the way it works is that in most businesses, 2 people are assigned to opening the mail. There's a cashier deposit and cash received, including checks, gets deposited in the bank, and the remittance goes to the accounting office. That's how it works. You have to control your cash payments. It's like, 101, right? Control your cash payments. Include it with the invoices, vouchers, remittance. You have to keep it all together. Yeah, that's the way it works. When it comes to the cash budget, the projections are included. So here's what I mean by that. Your customers are paying you, through the mail, through, whatever payment process. The timing is important of when you're receiving that cash, because that will help you to establish a cash budget for the future. It gives you an idea of when you'll normally be receiving cash payments. So you create your cash budget. You see? The accounting records are so important. You have to have what's called a paper trail, because if you ever get audited by the IRS, you're going to want to see a paper trail. We use what's called a voucher system. It provides a set of procedures and approvals designed to control cash payments, the acceptance of the liabilities. We verify, approve, and record any liabilities for eventual cash payments. Bills. Yeah. Number 2, we issue checks for payments of verified, approved, and recorded liabilities. The way I typically do this in business is before I pay any bill, I take the packing slip of merchandise I received, the invoice, the bill, the purchase order, I made the original purchase, and the check, copy of the check. So, purchase order, invoice. Purchase order, then the packing slip, the invoice, and then the check. Okay, those 4 things together. Paper clip them, get the signatures on the check, copy the check, put the check in the mail. Keeping those records together, you've created a voucher system of control. Okay, so important. This is a nice visual representation of it. You'll notice that all of these documents, the purchase order, the invoice, the receiving report, the packing slip, invoice approval, and then the check, all of them together represent the transaction. It's your paper trail. So if the IRS comes to audit you, here's your paper trail. Here it is. These are my transactions. They're all together. Yeah. Voucher system. So important. Every business should have that. Okay. Now we talked about voucher system. I need to talk to you about the petty cash fund. I'm going to talk a little story. I'll make you laugh. I'm sure I will. Little story, okay? Petty cash. Businesses typically have what's called a petty cash fund. Simple. A petty cash fund is designed for small payments for items like shipping fees, minor repairs, low-cost supplies. Just cash, okay? You make cash payments for real quick and easy things instead of running over to the accounting office and asking for a check. Example. I'll give you a couple examples. I used to work in the hotel business. Okay? I think I told you all this. I used to work in the hotel business. And one of the things, I was a financial controller for the hotel, which means I was responsible for the night auditors. Those are the people that work at the hotel overnight, at the front desk usually. They check in and check out guests, but in addition to that kind of thing, they're closing out what we call the guest folios. Okay, that's when they slide the little piece of paper underneath your door at night or send you an email. They're closing your account. They're closing your room out through the accounting process. That's what a night auditor does, in addition to their front desk responsibilities. Sometimes night auditors need to make small purchases using cash. Example, once in a while we would have guests from the airport coming to the hotel. We had a shuttle service that ran 24 hours. This is New York, so bear with me. Shuttle service ran 24 hours. If the shuttle wasn't running for whatever reason, a guest would take a cab from the airport to the hotel. We gotta pay the cab. Okay, so we use petty cash. The accounting office ain't open in the overnight hours. Don't go to them. They're not there. We're gonna pay the cab, petty cash fund. Okay, cab driver gives you the receipt. You give the cab driver the cash for the payment. That's how petty cash funds work. That's how it worked for me. That's just one example of many that I could give you that we've used petty cash for. Other examples include, local florist comes in and they do the lobby up, or they come and spray, the plants once a week or whatever. Small things, real small things. Run down the street, go get some postage from the post office. Real small things, These are the kind of things you use petty cash for. So, how do we establish a petty cash fund? Let's say it's a brand new business. We've never done a petty cash fund before. So here's how you establish it. Create a new account called petty cash. Debit petty cash. It's a cash account. Okay? It's an asset. Debit petty cash, $75. Credit cash, $75. That creates a petty cash fund. Now, we're going to use that $75 for various small things. That's what it's for. So over the month of November, here are some of the things I used the petty cash for. Transportation and merchandise, $15.05. Office supplies, purchase office supplies, $4.75. Delivery expense for a customer's package, $5. IO cleaning, I guess that's a thing, $46.50. The month of November, I spent $71.30 out of my petty cash fund. Now here we are, end of November. I gotta replenish that account. Okay, once you use the petty cash, you gotta replenish it. How do we do that? Take all of our receipts to the accounting office, and they make a journal entry on November 27th for each of the things we spent the money on. Debit merchandise inventory, debit office supplies expense, debit delivery expense, debit miscellaneous. I could have debited cleaning. I don't know. I would have debited cleaning, not miscellaneous. That's just me. Repairs and maintenance. You credit cash, that same amount. When you do that, you replenish your petty cash fund back up to the $75 original balance. And you do that every month with a petty cash fund, or whenever you need to. Yep. If we want to increase the petty cash fund, we could do that. Debit petty cash, credit cash to increase the fund. If you want to decrease it, you could do that. But cash, credit, petty cash. That's the beautiful thing about petty cash, it's very flexible. Of course, I have to say it. Sometimes the petty cash fund might be over or short. Okay. Not every time you're going to get a receipt. It happens. Okay? Might get in trouble, but it happens. So when that happens, you debit miscellaneous expense, debit over or short when it's short, you credit cash. Yep. And of course, the bank. We got to talk about the bank stuff. So we talked about all the cash stuff, got to talk about the bank stuff. Electronic funds transfer, we talked about that. Sending funds from one bank to another electronically. Checks, we talked about that. You could order checks from the bank. Bank accounts, they can open them at the bank. Now that's shocking. Signature cards. I don't like signature cards, but some businesses use these. It's a rubber stamp with your signature on it. Don't do that. Don't do that. They're available though. Tickets for deposit, also known as deposit slips. When you make cash deposits at the bank will provide you with the slips. Of course, bank statements. You get one of those at the end of every month. You should. Supposed to. Why is that important? Why are all these things important? Paper trail. Yeah. Deposit tickets. We fill these out when we make cash deposits at the bank. It includes a list of any checks and cash and coins and all those cute things when we make the deposit at the bank. It serves as proof of deposit. That's why it's important. A check. Oh man, look at this thing. Holy smokes. Paying whoever it's being paid to, dollar amount, the day we're paying it. Wow, amazing. What it's for even, and then a signature. And if you're lucky, a remittance. It tells you what it was for. Yeah, that's a check. The bank statement. It's a list of all the transactions that happened in your bank account over the course of a month. Cash that came in, the cash that went out, check numbers, EFT deposits. Oh, this one I don't like. Don't let this ever happen to you. NSF. Insufficient funds. You didn't have enough to cover that one. You tried to write the check anyway. Don't do that. Always know your cash balance before you go writing checks. Okay? You get caught doing stupid things, you're going to get in trouble. Promise you. Especially with NSF fees. The bank going to hit you with a fee. NSF check, that's a fee from the bank. You tried to write too much that you didn't have. $30 fee. Congratulations. A couple checks, a couple deposits. Oh, I like this one though. Interest earned. When you get interest on the cash balance that you have at the bank account. That's nice. Why is this important? At the end of every month, you should be doing what we call a bank reconciliation. This helps you to balance your cash balance in your accounting information system to make it match what you have in the bank. We call it a bank reconciliation. You want to do this once a month. You should be doing this once a month. Some companies, they wait. They'll wait a couple months. I don't like that. There's too much risk there. I prefer you do this once a month. Here's how it works. We look at the bank balance off of our bank statement. We add in any deposits in transit, meaning customer hasn't received that check yet, or the vendor hasn't received that check yet, or we haven't received that check yet. Add in deposits in transit, subtract out outstanding checks. Outstanding check is whoever you sent the check to, they haven't cashed it yet. They haven't received it yet. And we add or subtract any fees. They call it bank errors. I call it fees. Okay? Bank don't make errors. Compare that to our book balance, our accounting information system balance. Add in any interest earned and unrecorded cash receipts, minus bank fees and non-sufficient fund fees. Hopefully you don't have those. We add or subtract any corrections. That's how we reconcile a bank statement. You know, it looks a little bit more visually appealing. The bank side, we add in cash. We look at the cash balance that the bank has plus deposits in transit minus outstanding checks plus or minus errors and fees equals adjusted cash balance. Then on our accounting information system side, we take our book balance, our cash balance that we have in our accounting information system, plus collections and interest, minus bank fees and other fees, plus or minus errors, equals adjusted cash balance. Errors can also be because of misplaced some things. You didn't give enough change. Think like that. Equals adjusted cash balance. That's how we reconcile our books. Matching our accounting information system to what we have on our bank statement. Get our correct cash balance. That's how you know how much cash you have in your bank all the time. Nice visual representation of it using the steps that we described. Statement balance plus things in transit minus outstanding checks equals adjusted balance. That's on the bank statement side. On the accounting information side, cash balance plus collected stuff, collected interest, minus bank fees, other fees, equals adjusted balance. These two should balance. Okay. Bank statement matches what's going on in your accounting information system, plus or minus the things that are in transit and fees. That's how it works. That's exactly how it works. It's very straightforward. As you know, you gotta make entries for these things. Okay? You gotta make adjusting entries for these things to get your cash balance in your accounting information system to match what you have on the bank statement. Collection of a note, debit cash, credit note receivable, interest, debit cash, credit interest revenue. You had to pay for getting bank checks, debit. See, I don't like miscellaneous expense. I just don't like that account. If you have an account called bank fees, debit bank fees, and credit cash. SF check. In this case, it was a customer that bounced the check. Credit the account receivable. You better collect that fee from your customer. Then credit cash. Of course, it wouldn't be a lecture without me throwing some wonderful, your favorite thing to do ratios at you. This one I like. Okay, this is a good one. Days sales uncollected. Tells me how long it takes for me to collect my accounts receivable from my customers. That's what it tells you. What it really tells you. Okay. How quickly it converts to cash. Okay. To do that, we take total accounts receivable divided by net sales times 365 days. Gives you the number of days it takes to collect from our customers. And I have no idea why they use Starbucks and Jack in the Box for these examples, because those two companies have a lot of customers that are using accounts receivable. Okay. One of the last things we do with, and we're talking about cash, we're talking about internal controls. The documentation is so important. And I mentioned this before. That's why I'm mentioning it again, because it's that important. Anytime we're issuing a check to pay for something in the business, like with the purchase order, okay, the receiving report, the packing slip, and the check. Paper trail, so important. Invoice approval process. County department records the process. Information across the documents are verified. Invoice approvals there. Yeah. Invoice approval process, very important. And of course, lastly, the voucher process. After the invoice has been checked and approved, use a voucher. Use an authorized records obligations, with all kinds of information in the voucher. Information related to that voucher. Are there any questions about cash, internal controls, or anything related to this chapter that you have questions about that I did not answer? And hopefully I kept you entertained through this process. Go ahead, Leland.
Oh no, sir. I didn't have any questions. I was just yeah, I was just thinking about all the things you said. So
Cool. Awesome. Great. Any other comments, questions, concerns? Okay. Before I let you go, we're going to talk about the midterm exam. We got about 20 minutes to do so. It won't take that long. Well, let me stop the recording here for this chapter. I'll start a third recording for the midterm. So stand by.